With the rise of stimulus checks over the past year, it's not a surprise that we'll have to be paying for this in some shape or form, whether it be in taxes or inflation. Either way, the purchasing power of our wealth must go down when hefty government bills are created. The Biden administration is intent on creating a huge tax hike that could stifle innovation with growth-related stocks and may possibly lead to a sell-off in certain stocks. In this video, I will cover why Cathie Wood, the CEO and CIO of ARK Invest, believes that the Biden presidency's tax hike could lead to a drastic change in the market climate. Welcome to Cathie's Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. Before we get into why Cathie Wood is wary about the Biden tax hike, let's go over what the Biden tax plan actually consists of. The Biden tax plan has been spooking the entire stock and crypto market and has led the stock market to correct and Bitcoin to fall below $50,000 per coin. But first of all, we need to get some historical context. Back in 2017, former President Donald Trump slashed the corporate tax rate from 35% to 21% and a series of other decreases in taxes. Joe Biden looks to reverse a lot of these changes, which, according to UPenn's Wharton model, will increase US tax revenue by $2.1 trillion. These changes will have many rigorous implications on the stock market, so it's important to understand what we're actually talking about here. The first major change in the Biden tax plan is an increase in the corporate tax rate. Biden is looking to increase the corporate tax rate from 21% to 28%, which essentially reverses a huge portion of Trump's decrease in taxes 4 years ago. As you can see in this graph, the US corporate profits as a share of the GDP is relatively low compared to other countries worldwide. An increase in the corporate tax rate could lead the US to be on par with most of the other countries in this graph. Yet, that's not the only important part of the tax plan. One major change that's coming is a guaranteed 15% tax rate for big firms. Today, plenty of large companies don't pay the full 21% corporate tax rate. Some companies don't even pay a single cent. This is done through all kinds of tax code provisions, including deductions, offshoring, and exemptions. Joe Biden plans to end all of this. He plans to create a 15% minimum tax rate on book income, which represents the profits that companies report to investors. The reason why he wants to do this is because some companies report income to shareholders that doesn't actually get taxed much due to a variety of loopholes. That way, these large companies can report extremely high incomes while not paying much tax at all. Biden's new tax plan will make it so that companies with an annual income above $2 billion have to pay at least 15% of taxes of their book income. The Biden administration estimated that 45 corporations would have to pay this 15% tax rate. Now, this wasn't the worst case scenario, as Biden was planning to put this mandatory 15% tax on companies with $100 million of annual profits, but now it's been raised to a minimum of $2 billion. Another major change coming is a doubling of the global intangible low-taxed income. That might sound like nonsense right now, but it will all make sense. Right now, many companies move their profits overseas in order to get a lower tax rate. For example, profits can be moved to China in order to benefit from lower costs and lower taxes. Again, Biden is about to end this. He wants to increase the global intangible low-taxed income to 21%, which basically doubles the tax rate for the income that companies make overseas. To put this into context, Tesla's profits for its China operations will now be taxed at a much higher rate. What this means is that Tesla may have to increase the price of its vehicles or simply make less profit. In addition to these, there are also numerous other changes that are being made to end profit shifting. Another portion of the Biden tax plan that has been scaring investors is the increase in the long-term capital gains tax rate to as high as 39.6%. This is a huge increase in the current base capital gains tax rate of 20%. And keep in mind that this is only at the federal level. After all, we have to pay taxes on the state and federal level. For those in New York, the capital gains tax rate combined at the state and federal level could be as high as 52%. For Californians, it can be as high as 56.7%, so these are clearly extremely high numbers. The Democrats have been arguing that the current capital gains tax rate makes it so that people can get their income from investments rather than wages. Consequently, this disincentivizes the wealthy to create businesses and hire people when they can simply make money through investments. On the other side, the Republicans are arguing that the current capital gains tax rate encourages people to save money and helps the economy grow. Either way, we know that an increase in the capital gains tax rate is harmful for us investors. The last major change coming is the replacement of fossil fuel subsidies with clean energy incentives. There have been many government payments for oil, gas, and other fossil fuels for years now. But now, Biden looks to replace this with clean energy incentives. The Treasury Department estimates that the elimination of fossil fuel subsidies will increase government money by over $35 billion in the next decade. This essentially means that oil and gas company profits are about to lower substantially. Politicians have tried to do this before, but it's been difficult to pass because Congress and the energy industry have consistently opposed this idea. Overall, we know that the Biden tax plan will likely increase US tax revenue at the sake of company profits. With that being said, let's get into why Cathie Wood has been wary about the Biden tax plan. Cathie first publicly spoke about Biden's tax plan back in late 2020, before the election happened. Cathie stated that if Biden wins, we believe some of the platforms and technologies have hit escape velocity and are on their exponential growth trajectory already. We don't worry about those, and they may actually gain more traction if taxes and regulation go up. Now, while some large companies such as Tesla have reached exponential growth, others may still get crushed by the tax plan. Cathie mentioned that the smaller innovative companies would be crushed by the Biden administration, whereas the larger innovative companies may actually benefit from the regulatory moat. Outside of innovation, she declared that her and ARK Invest as a whole believe beyond the evolution of innovative platforms, the US will lose its competitive edge when taxes and regulation are going up, and we believe innovation will effectively be exported to the rest of the world. In other words, innovation isn't going to be as fast as before in the US. Cathie also spoke on this subject in early 2021, where she warned that taxing the rich has not been a good strategy. When it comes to state income taxes, we've already seen the migration of people to low-tax states. For example, Oracle, Palantir, HP, and Tesla have all left California due to high tax rates and regulations. The major clash with Elon Musk in Fremont, California that occurred with the reopening of Tesla's operations was a strong manifestation of the kind of movement occurring. Cathie thinks that a similar type of migration will happen with the US. People in innovative companies will be migrating outside of the US because of high taxes and regulation. She's hoping that this doesn't happen, but does see it as a risk with the Biden tax plan.
The most damaging parts of his proposals or purported proposals are increased tax rates, and focusing on certain income levels. So the marginal tax rates, the highest ones, we have seen has not been a great strategy. Administrations in the past who have tried to do that have found that the tax base would disappear on them. And we're actually seeing this, it's in response to the coronavirus, but we're seeing a migration to low tax states. That is very visible on both coasts. And I think that this new administration is going to, they're going to hear the other side of the debate in terms of what else will migrate. And as I've mentioned before, many times, it could be if they raise capital gains tax rates and corporate taxes, and increase regulation again, that we will probably see a migration of innovation and innovative companies and creative people to other parts of the world, either back to their home countries or and so forth. And our strategies are global in scope, so we will follow them. And so we're hoping this does not become a trend, but we do believe it is a risk.
It's also notable that higher tax rates does not necessarily lead to higher tax revenues. In the early 20th century, when the US government raised taxes, they actually received less tax revenues overall than prior to raising tax rates. This is because people are not dumb, and especially those with lots of money. In my opinion, they will just find other ways to protect their capital against taxes, and the Biden tax plan may have adverse effects going forward. Overall, it's clear that ARK Invest believes that the Biden tax plan will bring some asymmetrical advantages. Large companies like Tesla and Square may actually benefit from high regulation because it prevents other smaller companies from passing through regulations without the economies of scale. On the flip side, innovation might accelerate faster internationally than domestically, which is generally not a great occurrence. However, some companies heavily exposed internationally like Tesla could actually benefit from the acceleration of innovation internationally. Let me know what you think about Biden's tax plan. Will it be beneficial or harmful for the positions you own? If you enjoyed this video, please hit that like button and don't forget to subscribe, and I'll see you in the next one.